Somewhere, right now, a 28-year-old is putting $500 into a short-term trade, convinced they'll double it before summer. And somewhere else, a 52-year-old is holding a portfolio they built 20 years ago, quietly watching it work while they sleep. Both of them made decisions. Both of them had reasons. But only one of them chose a timeline that matched who they actually were. The most expensive mistake in investing isn't picking the wrong stock. It's picking the wrong clock. If that landed with you, stay with me. Because by the end of this, you won't just understand the difference. You'll know the right one to choose. Let's start with what the data says. Because opinions are cheap, but research is expensive. The Dalbar Institute has tracked real investor behavior for over 30 years. Their annual report consistently shows the same thing. The average equity investor earns significantly less than the market itself. In 2023, while the S&P 500 returned over 26%, the average investor captured less than half of that. Why? Not because they chose bad stocks, but because they exited too early, re-entered too late, reacted to volatility instead of outlasting it. Vanguard's research backs this up. They found that investor behavior, specifically the inability to stay invested during downturns, accounts for a performance gap that compounds into hundreds of thousands of dollars over a lifetime. Daniel Kahneman, the Nobel Prize-winning psychologist, called it loss aversion. The pain of losing $1,000 feels psychologically twice as powerful as the pleasure of gaining $1,000. That asymmetry doesn't just affect how we feel, it drives the decisions we make. Short-term investing is often misunderstood. People assume it means day trading, charts, tickers, 3 screens, adrenaline, and yes, that's one version. But short-term investing also includes flipping into trending sectors, rotating positions every few months, or chasing whatever the algorithm put in your feed last Tuesday. The invisible cost isn't just the trades themselves, it's what JP Morgan calls the tax of activity. Every trade has friction. Brokerage fees, bid-ask spreads, short-term capital gains tax, which in the United States can be taxed at your ordinary income rate, not the lower long-term rate. For active traders, this can quietly consume 20 to 40% of theoretical gains before they ever see their account. But the deepest cost is psychological. The Federal Reserve's survey of consumer finances shows that households who trade frequently report higher financial anxiety, not less. They're constantly monitoring, reacting, recalibrating. Short-term investing demands your attention as a full-time job. For most people, it's a job they were never hired for and never paid enough to do. Now let's be honest about long-term investing, because the internet makes it sound effortless. Just put it in an index fund and forget about it. That's technically sound advice, but it omits something crucial. Long-term investing requires you to do nothing during periods when everything inside you is screaming to do something. In March 2020, the S&P 500 dropped 34% in 33 days. Fidelity later reported that accounts showing the best performance during the following recovery period weren't managed by genius traders. They were accounts where the owner had forgotten the password, or accounts belonging to deceased investors. The market rewarded inaction. But here's the hidden trap. Long-term investing only works if your timeline is genuinely long. If you need the money in 3 years for a house, a business, or an emergency, putting it in equities and staying the course is not a strategy. It's a gamble with your actual life. Kahneman's research shows that we are systematically bad at predicting our future needs. We discount how much we'll want liquidity in 24 months. We overestimate our emotional tolerance for watching a portfolio drop 30% without selling. Patience is not a virtue if you're patient with the wrong asset for the wrong season. If you've made it this far, it tells me something about you. You're not here for a hot tip. You're here to actually understand how money works and how it relates to your real life. That's the kind of thinking that separates people who build wealth from people who just talk about it. If this is landing, hit the like button right now, subscribe if you haven't, and leave a comment telling me, are you naturally a short-term or long-term thinker? Let's keep going. So how do you actually choose? Not by what the market is doing, not by what a podcast told you, but by a three-part life audit. 1. Timeline. When do you genuinely need this money? Not when you hope to need it. When do you actually need it? If it's under 3 years, equities are statistically high risk for your situation, regardless of market conditions. 2. Liquidity need. Do you have a fully funded emergency reserve separate from your investments? If you're investing money you might need next year, you're not building wealth. You're gambling with your security. 3. Emotional tolerance. And I want you to answer this honestly. The last time the market dropped significantly, what did you do? What did you feel like doing? If the honest answer is I wanted to sell everything, then a long-term, equity-heavy portfolio will hurt you, regardless of its theoretical upside. Your psychology will override your strategy every single time. Vanguard's behavioral coaching research shows that investors who work with a framework, even a simple one, outperform emotionally reactive investors by an average of 3% per year. That's the power of a decision system over a decision impulse. Here's what most finance content refuses to say. There is no universally correct answer between short-term and long-term investing. The correct answer is the one that matches your current season of life, not your aspirational season, not the life you're planning to have in 5 years, the life you are actually living today. A 24-year-old with no dependents, a stable income, and a 20-year horizon, time is their most valuable asset. Volatility is not their enemy, it's their opportunity. A diversified, long-term, index-based portfolio with consistent contributions is likely their most rational path. A 38-year-old launching a business with a family and irregular income, liquidity is everything. Their investing strategy needs to honor that reality. Keeping capital accessible, even if it means lower theoretical returns, may be the actual wealth-building move for this season. A 55-year-old approaching retirement? The calculus shifts entirely. Sequence of returns risk, the danger of a major market drop in the early years of drawing down your portfolio becomes the dominant threat. Preservation starts competing with growth. Different seasons, different frameworks, same market. The mistake isn't investing short-term or long-term. The mistake is borrowing someone else's timeline for a life that doesn't look like yours. So I'll leave you with the question that actually matters, not which investment vehicle has the best historical return, but which strategy can you emotionally sustain, financially execute, and rationally defend, given the specific, real, unglamorous details of your actual life right now? Because the best investment strategy in the world is worthless if you abandon it under pressure, and a suboptimal strategy you can actually stick with will always outperform a perfect strategy you never maintain. Your timeline isn't just a financial variable. It's a reflection of your values, your season, and your self-awareness. Choose accordingly. If this video added value to your thinking, like it, subscribe, and turn on the notification bell. I drop content designed to help you think better about money, life, and decisions that actually matter. I'll see you in the next one.